Julian, Robertson, Stan Druckenmiller, and others have recently highlighted the danger of keeping rates too low for too long. Effectively, they are prioritizing the risk of bubbles over growth and recommend a rate hike in the near term. How do you differ from this view, and does your asset selection change based on Fed action over the intermediate term?
I mean, to not acknowledge it, all of this is quite bubbly from a central planning expectation perspective. In other words, that the planes are all going to land safely would be reckless. I mean, those are two very thoughtful guys, obviously. And what I'd say is this. Raising interest rates when the rate of change in the two core metrics, growth and inflation, are decelerating is a huge and potentially catastrophic mistake. What the Federal Reserve should have done is raise rates when economic growth and inflation expectations were rising. So what we show that is at the end of 2013, when the year-over-year growth rate in U.S. GDP peaked at 3.1% year-over-year, the Fed had a window in the September meeting to raise rates, and they backed off because they were scared of everyone from the bond lobby to whatever the politics of the moment were. They missed the window. So now you can't, it's like telling my dad hey, we believe highly in fighting this fire with water. And you know, right about now, when you're at the riskiest point of that door being blown open, you should send your guys in there right now because it's the right thing to do. Put water on that fire. The reality is that there's a point in time to raise rates. There's a point in time, to use the fire analogy, to wait and watch. And right now is the time to wait and watch. Even though I don't believe that in ZIRP, I don't believe in any of this, I'm telling you that if you raise rates right now, you will knock oil to 20, and you will take out all the wage growth gains, and you will expedite all these late cycle losses turning into early cycle recessions very quickly.